This is the daily fiscal pulse for the 11th of August, 2026. We're looking back one day, showing you how the money moved through Tuesday's market close. Before we get into the numbers, let's talk about what's moving the conversation. Right now there's no clear dominant narrative cutting through, but the headline that's resonating across markets is this: the US budget deficit surged in July to its highest level since March 2021. That story is clearly shaping how traders are positioned and what they're watching. With that context in mind, let's see what the actual fiscal flows tell us. The headline number on net transfers is $7.0 billion. Standing alone, that's unremarkable. What matters more is the trajectory. The 5-day flow has compressed to roughly half its recent run rate, and the story behind that compression is straightforward. Tax receipts did the heavy lifting, coming in at $5.2 billion. Here's something worth noting though. Prices are actually pushing through this headwind. ES futures closed at 7,750, which keeps us above the 20-day moving average sitting at 7,580. Your 20-day range is about 474 points wide. So despite the fiscal pressure, equities are holding their footing. When you zoom out, the deceleration becomes impossible to ignore. Government spending on a 5-day basis is averaging roughly $0.2 billion per day now. Put that against the 20-day average of $9.6 billion, and you've got a stark picture. Cash isn't flowing through the system the way it was. Less money in households means less money eventually finding its way into markets. The result is tighter financial conditions across the board. Year over year, the same story holds. We're at $1,461.2 billion for the fiscal year to date. That's roughly 13% lower than the same stretch last year. When you're pulling back that much fiscal support, it ripples through overall system liquidity. For people thinking about going long, the fiscal backdrop deserves real consideration. This environment isn't tailwind territory. Our conditions gauge is sitting at -71. That said, history gives us some perspective here. We've been in this exact type of setup many times. Even with thinner liquidity, the S&P has averaged around plus 1.5% over the next month. Money doesn't move in lockstep with fiscal flows. Sometimes it just keeps grinding higher anyway. The positioning picture adds nuance. Margin debt is sitting at the 100th percentile. That's genuinely elevated. Historically, when you see numbers like that, it's more of a warning than a green flag. So here's how this all connects. Fiscal flows are running below last year's baseline, which means there's less cushion built into the system. When good news lands, sure, equities can work higher, but when a risk event emerges, like escalation in the geopolitical backdrop, the down move can accelerate faster because there's simply less liquidity underneath to catch it. Two things on the calendar worth watching. The 12th of August brings the SSA payment cycle, second Wednesday of the month, which tends to shift near-term flows around. Then the 15th of August is when the next significant Treasury coupon interest payments are scheduled. Fiscal drag is showing up loud and clear in the data, but the rate of that tightening may be stabilizing out. What happens next really hinges on how these scheduled payment flows actually land. That's the setup we're working with.